Thank you very much, Richard. Hello and welcome to Blockchain Connect. We are live from Dogpatch Labs in Dublin and delighted you're joining us for our webinar today, Dawn of the Digital Capital Markets, brought to you by Lab 577. This webinar is being recorded live and there will be time for audience questions later. So if you just enter your question anytime, we will then come to those questions at the end. So let's get started. Some introductions. I'm Charlie Corbett, your host today. I'm an author, financial journalist, formerly of the FT and Wall Street Journal, and founder of the Plain Speaking Institute, which is a communications consultancy. We are joined by Stephen Kelso, an investment specialist of 25 years standing, and most recently head of Galaxy Digital, a diversified merchant bank dedicated to the digital assets and blockchain technology industry. Greg Chu, a fintech veteran, if there is such a thing, and founder of QPQ, a distributed digital exchange network that reduces cost and transactional friction by automating and digitalizing transaction processes. Last but certainly not least, Richard Crook, director of Lab 577. Apart from being our sponsor today, Lab 577 is a team of distinguished engineers that transform traditional financial instruments into digital assets via the digital asset shared ledger. I hope I've got that right, Richard. Hopefully we'll hear a bit more about that later. So welcome everybody. Thank you very, very much for being with us today, all of you, our panelists and our audience. Let's get going. Technological innovation has long been a key driver of success in financial services, but digital innovation within capital markets firms, primary issuance, secondary trading, investment, currently trails far behind other industries. Indeed, other areas of banking, such as transaction services. Capital markets consultants are now calling 2020 the dawn of the digital capital markets and predict that we're going to see big volumes of digitized financial securities, or STOs, issued and traded using distributed ledger technology. The world's about to change. This is going to lead to tokenization of traditional asset classes and can even lead to entire new asset classes like fractional real estate. I want to learn more about those later too, but let's just start now with how prepared the capital markets are for this digital revolution, the kind of state of play today. That's how we'll start. And then we're going to talk a little bit about the implications for the industry, for their clients, for markets of this digital revolution. And finally, we'll probably get our crystal balls out and have a look at what the future might look like. So let's get going. My first question, directed at you, Richard. I'm sorry I'm not in the room, so it's no eye contact. Why have capital markets been so slow to digitize when other parts of the market have embraced it? Why, Richard?
So I think the easiest way to look at that is separate digitization into two definitions. So for the retail and commercial banks, they're going through digitization to move from branches to mobile banking, from some private lines to APIs. And as our friends over 11FS always used to say, they're only 1% done. So they've got a long way to come to get actually anywhere close to where the capital markets businesses have already evolved to. So the retail and commercial banks are very much going on a different revolution. They're going out of the paper and the people into the actual mobile phones and the APIs. Over in the capital markets, that was done 20 years ago as they moved from paper to electronic. What we're now actually seeing in the capital markets, we call this the dawn of the digital capital markets, is a digitization of the actual financial instruments and getting them out of those databases and into a common fabric or blockchain.
Okay, thank you, Richard. Stephen or Greg, do you have anything, do you agree for a start, and do you have anything to add to what Richard just said in terms of this kind of the slowness to digitize?
Yeah, so I think this is Steve speaking. I think like the one area that has already really started to take off is that digital gold, and that store of value. And of course, it's a fairly volatile store of value, but nonetheless, I think the institutional adoption of Bitcoin in particular is already happening. Like the biggest pool of actively managed assets globally, as we know since the crisis, we now refer to as the multi-asset community. The big US endowments very much at the vanguard of that whole movement, the first to really systematically apply that CAPM efficient frontier model. Those investors started investing in Bitcoin as another asset class that was not totally correlated to gold in particular, that had some of the upside, certainly the upside octane potential without the leverage, and as I say, with low correlation to gold and the other asset classes within their portfolios. So actually those big institutions started investing, albeit in a small way, 20-40 basis points for many of the limiting factors that we know, particularly around security and the hacking and so on and so forth. But actually that has started to happen, and I think, you know, what's now clearly as we're sort of moving into the latest cycle of this most extraordinary investment cycle, with rates continuing to go down, and obviously the current sort of coronavirus going on, very much heightening people's focus on, okay, helicopter money, what's next? We've had the rate cuts, is that enough now? We need more money. I think that increases the focus again for the need for that within portfolios. So I think that is happening, but the various sort of chessboards within digital assets, I think they're evolving at different rates and at different speeds.
Exactly, so different. Greg, sorry, would you like to add anything?
Yeah, just supporting what Richard's pointed out. You know, the digitization, the process of digitization is really at very nascent stages when it comes to retail banking. There's a very, very long way to go. I've actually made the argument to senior banking boards that you've already lost the retail fight, because the likes of Apple, Google, and so on have already had your lunch, breakfast, and dinner. What you can do is going to be to support what they do, and you know, to an extent, PSD2 attempts to do that, albeit it's not all that well thought through a plan, in a sense, because ultimately it does give them the capacity to eat their lunch, breakfast, and dinner, and then you have to wonder who is actually going to provide the infrastructure that underpins it all if it's not the banks. And that's something that we're trying to address. But you know, talking to digitization versus digitalization.
Yes, what's the difference?
Digitalization is something the capital markets have done an awful lot of, because the size of what goes on. You know, people talk about the size of a market. The size of the capital market business is about $10 quadrillion, and that's just US and Europe. It's an absolutely vast market. So the capacity to have marginal incremental gains from digitization has been well adopted within a capital market context. Ricardian contract theory came from zero coupon bonds. So you know, I think vis-a-vis capital markets, exactly as Richard said, the movement is not to digitize processes so much as it is to do two things. One is to digitize assets themselves, and the second is to move to digitalization, which is a leap beyond that again.
So this is about assets particularly, and so why? You know, let's go back to what, you know, the title of this, Dawn of the Digital Capital Markets. Why now? Why is everyone saying this is happening now, and what particularly has driven this change, or this new attitude, or this new feeling?
So I think the two main drivers that come together out of the back of the 08 crash, the regulators moved quickly to place more conduct risk upon the financial institutions, and the financial institutions responded as they should, and removed any of the retail or lower investors from the financial institutions and from their customer base. So you've then got this pent-up demand from retail customers and retail investors wanting access to these financial institutions or financial instruments. At the same time, for the last decade, we've been watching a new technology in blockchain. Bitcoin being the first, as an experiment, has shown that we can create digital assets that can't be copied or duplicated. Now, we've created digital assets in the past, CDs, DVDs, and we've very successfully copied them, Napster, Pirate Bay. But what we have shown with Bitcoin over the last decade is it will hold its price in the market. Yes, it goes up and down, but actually, if that technology was broken or in some way flawed, then price will go to zero immediately, very quickly, in fact. So if actually you bring
Bitcoin today
together,
sorry.
back in 2018, those two things came together and started a fire inside the capital markets, which was the ICO, where people were creating issuing securities or issuing tokens that would represent some sort of project, some sort of venture. And that, at the end of it, is what capital markets is about, bringing investors together with capital. And that's exactly what they did. Now, they raised over $20 billion in 2018. To give you an idea of why that's important, because it sounds like a small number compared to the trillions going through the financial markets. The AIM market in London, which is the junior market, which is kind of where those ICOs should have been, only raised $4 billion. So it gives you an idea of just how much pent-up demand came out of Asia, came out of the US, came out of Europe into those ICOs, and that has triggered into the capital markets a wave of disruption that we haven't seen for a while.
I would say this is part of a process, because it's exactly identified, what Bitcoin did, and I'm not a Bitcoin fan. What it did was it did prove that there is this need, this desire out there, and that the retail investor has been cut off from. But right now, without having to break any of the regulations or rules, we can actually address the huge market that is unaddressed, which is, we calculated out that 99.71% of the people with more than $1 million in liquid assets in the world have no access to direct deal flow. Because if you're looking at it from an investment bank's perspective, if you can't write a check for at least $5 billion, you don't actually count to have a conversation with. And in order to have $5 million and decent portfolio management theory applied, you need to have a very, very large amount of money. So what about all those people who are in between the $1 million point and the $30 million point, who are, by any definition, high net worth or very high net worth, but don't have access to this deal flow? And that's the potential that we can address without breaking or even abusing the spirit of the rules. And that's where I think the focus needs to be for now, with the aim to be that if we can get some prudent, rational players in this market who behave with the regulations, who actually converse with the regulator, there is the potential to address that far greater market. And to put that in numbers, we're talking about a market of $13.995 trillion who have over $30 million in cash. Those between 1 million and 30 million is 72 trillion market. The market that we could potentially address if we can talk to people who've got more than $25,000 to invest is actually $254 trillion. So these are the goals that we can access if we play by the rules, if we behave in an intelligent way, and we address the market, the regulator, all the stakeholders like adults.
So that's the market that tokenization essentially opens up, is what you're saying.
Sorry, was that a question to me?
Yes, sorry, yeah, I'm not in the room. So yeah, so basically, just to sum up, that enormous market is being opened up by this digital revolution, this tokenization,
Yeah,
this technology.
It's twofold, Charlie. On the one hand, you have I don't think the cost of issuance has fallen at all. I don't know what your view on that would be, Richard, but I don't think the view is only low. The cost is only lower for the actual issuance. Where the gains are is that with broader participation, you should get better pricing on the asset in the first place. And the major gain, what enables the former to happen, is your long tail costs fall away to virtually nothing by comparison with the current. So in effect, what you do is you make possible a public market offering at private listing prices.
Okay, you mentioned at the beginning, Greg, that your first word was, "I'm not a Bitcoin fan," and it's interesting. There's a lot of sort of I suppose skepticism maybe around the image of Bitcoin. Does this infect the image of other digital assets? How can we separate this sort of fact and fiction of Bitcoin? Does it suffer from an image problem? Do cryptocurrencies suffer from an image problem? I ask, that's open to anyone in the panel to answer.
Yeah, I think you look at Bitcoin being the original one, continues to get the headlines, but that started a cloning process where people created their own altcoins, be it Ripple, Dash, Zcash, and you suddenly realize that anyone could create a currency. The difficulty is getting people to use it, and that's created a $250 billion crypto market. Now those coins are the first, just much like Netscape was the first, but they probably won't be the winner. Is a fair bet. What that has proven is the technology, and off the back of that, we're now seeing asset-backed tokens, securities coming out as tokens, so security token offerings, and those are actually backed by real assets, real financial assets, and people are starting to soak those up. And what we're seeing is an evolution where those financial institutions that may have started in the crypto space are coming into the regulatory space when they realize that what they're doing is a regulatory regulated activity, and they're taking regulatory licenses. So they're becoming financial institutions, they're becoming banks. And the banks, on the other hand, at the other end, are looking at this crypto market and recognizing that their clients want access to some of these currencies, and they are starting to get involved in crypto. So you see Fidelity starting to do custody and so on and so forth. So we always use the kind of last line in Animal Farm, which is that the creatures looked from pig to man and man to pig and could not see the difference. And that convergence is clearly coming.
So that's coming because skeptics would say about crypto, you know, it's just a speculation. It's not a swift or easy medium of exchange for everyday goods. They might say the price is too volatile for it to be a reliable store of value, and it doesn't yield anything like a normal currency.
Charlie, firstly, it's not a currency. Secondly, it's not an asset in the context of how we would describe an asset in financial markets. What it is at best is a consensual store of value between consenting adults who wish to play with a cryptologically secured betting slip on a very long run.
Betting slip, I like it. Right, that should provoke some comment. Steve, not heard from you for why it's a betting slip.
Betting slip, yes. It's a. If you think of the Grand National that doesn't end, that's the Bitcoin game.
And Richard, would you agree with that?
But it has no intrinsic value. It has no means of objective valuation. Its only value is subjective, and its market price is a factor of who's betting on the day. And actually, most of the data is completely flawed. It's inaccurate. I used to design algorithmic trading systems. You need huge amounts of data. You need that data to be absolutely spot on. I mean, I used to build stuff off tick data being the actual transaction going across the exchange. You have multiple so-called exchanges that are trading Bitcoin, and actually most of the volumes, most of the data in there is completely flawed. They're not actually exchanges. They're single market maker specialists who are essentially playing with or against their client base. That does not give you the basis to have any kind of solid technical analysis. It's anybody who tells you they can do real technical analysis on Bitcoin, I'm afraid it's a farce. It's just not, well, maybe you can, but then again, I can tell stories about unicorns and leprechauns too.
Yes. Does everyone else agree with that?
I disagree. Hi, this is Steve.
Hi, Steve.
I observe that the capital markets are built on leverage. Capital markets are, as we have said earlier, based on the premise of people playing by the rules, and that whole issue of trust obviously is central to this whole technology. But I think it is not accurate to say that it's not an asset with some value, because it does perform the portfolio requirements that certain investors are looking for, and we can talk about that whole sort of that digital value store of gold argument. But I think that digital gold is but one of 3 chessboards that are going on within the digital asset space. The other 2, of course, are let's call it 10 years ago we talked about the Internet of Things, and now we're talking about the Internet of Value and how we monetize the data that is shared between all these devices. That enterprise investment realm is about efficiency. It's about increasing the market size. you know, it is about disintermediating many of these internet rent takers that are up there now. So that is still very much at the VC, the private equity investment stage. But the third chessboard that I think we're sort of, you know, focused on this webinar is of course tokenization, real assets that what we're really talking about is access. Okay, so I look a lot through the lens of the equity market and the playbook of the equity market over the last 20 years. And when equities went electronically traded, suddenly, you know, the investment banks were asking themselves, okay, what's the right to win here? And they found very quickly it was to leverage their balance sheets, and that manifested through two main areas: through portfolio margining, securities lending, and through derivatives. And derivatives, of course, you know, in the first instance, people think leverage, and derivatives absolutely are about leverage, but they are actually more about access. And people will recall 20 years ago when CFDs came online, the UK stock market absolutely exploded, and there was a similar ripple effect across Europe as well when the London stock market really took off as it did back then. So I see derivatives are about leverage and they're about access. And I see that there are two types of players required in the derivative market. You need the end users and people looking to hedge out a particular risk, and you need speculators. And I observe that today, you know, what is happening now that was not happening 12 months ago is that actually in this tokenization realm, you actually do have now some real users, some proper industrial clients who are now looking at tokenization as a viable means to access more. We've already sort of heard that statistic about, you know, whatever portion of wealth has actually got access to the capital markets. What we're now seeing are big industrial players now looking to tokenization, to increase the breadth of their market. And that means that they can also broaden the number of types of players within their market. So no longer are, let's say, natural resource companies just speaking to other industrialists looking to buy their natural resource offtake. Now, obviously, you have the potential for other capital markets, the hedge funds, to come along and play various arbitrages between the physical futures and now maybe some of these tokenized assets. So that just simply wasn't on the table to happen for various technical reasons that Richard's very eloquent at expressing. That just wasn't available 12 months ago, but now it's happening. So I think that whole sort of derivative analogy to how the equity markets unfolded 20 years ago is very relevant, but so too is the whole emerging market angle. So, you know, for 25 years, you know, people have compartmentalized this difference between developed markets and emerging markets. And I think that can be summarized with essentially emerging markets represent less efficient capital flow opportunities. And again, you know, when emerging investments came online in the equity market over the last sort of 10, 15 years, it transformed investing, it transformed the capital markets. And I believe digital assets and tokenization are an extension of this emerging market phenomenon, this globalization phenomenon. I think it's no coincidence that many of the players who are now looking at the digital asset space share a background in derivatives and emerging markets for that reason. And I observe that much of our sort of developed market attention is on the fractional ownership of essentially pro-cyclical luxury goods. But when I look at the real use cases, I think it is much more exciting. I think there is much more potential when we look at the next stage of essentially ironing out this compartmentalization between developed markets and emerging markets. I can see emerging market players, particularly natural resource players, really starting to lead the charge and come to prominence with the tokenization of real assets.
Can I just, we'll talk about the future in a minute. I kind of want to wind back a little bit about tokenization, because I want to sort of words of one syllable practical example. So you've got an issuer who issues a bond, And then that bond, the primary issuance, is then sold on secondary markets, traditionally over the telephone. How now is tokenization changed that process? Literally for a bond, let's say.
For a bond now that is tokenized, suddenly no longer does a family office, a hedge fund have to go through their prime broker, their syndicate investment banker to gain access to that bond. No longer do they potentially have to buy a minimum clip size of $10 million to invest in that. Now a hedge fund investor, a family office investor, a multi-asset portfolio manager can now say, actually, I'm happy to have 50 basis points, 200 basis points, 5% of my portfolio access this, particularly this asset that has got particular characteristics. Maybe it's cheaper and higher yielding, maybe it's a little bit more esoteric, and historically it would have commanded too much of my resource to do the due diligence, to do the bandwidth, actually taking delivery, taking custody of that. Historically, of course, there would have been less exit opportunities. With the whole tokenization, what we're basically doing is giving access to more people to invest. And of course, the flip side of that means potentially more liquidity, potentially an easier exit. Now, clearly just listing the security does not conjure up, does not magic up liquidity in it, but clearly giving access at least creates that opportunity for more synapses to connect in the capital markets.
Does it also create the opportunity for more volatility, for flash crashes of the kind of US Treasury kind in 2014? Is that a danger?
In theory, if you broaden,
I think that
will actually reduce, not increase. It's portfolio management theory applied in reverse.
So does everyone agree that actually it reduces volatility and there's less chance of a flash crash because of this?
I'm not necessarily sure that's true. I think that, look, the big assumption that many of us had, certainly back 2005 to 2008, before the crisis, was that essentially the more connected capital markets as they were then would essentially and dilute any big impact. And of course, that was not the case. What came to pass was very much the domino effect. I think at the heart, though, of any question about flash crashes, it's that central concept of managing risk in capital markets, and that essentially always comes down to the balance of three factors in my experience. It's the volatility of the asset, it's the leverage that is in the system, and it's the liquidity. So I think simply tokenizing assets does not necessarily have an impact one way or the other on the likelihood of a. What does is when the leverage in the system creeps up and up and up and up, and it is not, to be clear, tokenization that is driving that leverage in this macroeconomic background that we've seen since the crisis.
We'll just quickly move on. Can somebody? We want to talk now a little bit about new asset classes that are going to come out of this. We've talked a bit about older asset classes and how well suited they are. What kind of new asset classes can we, ordinary people, look to invest in because of this? And I know we mentioned fractional real estate, Greg. That's something you're an expert in, the new asset classes. What are some new asset classes?
I don't necessarily think that they're new asset classes per se. I think what they are is asset classes that were around for a very long time that are being made available at a different level. The analogy was made earlier to CFDs, which I think is actually erroneous, because what we did with CFDs is effectively allow people who were either going to self-declare to be professional investors or who had sufficient capital to be professional investors to play a game with a single-sided market on leverage, which I don't think is a good analogy to what we're doing with tokens at all. And in fact, the whole reason that I think tokens can be so powerful, and we talk about this within what we're building in our system, is that we know the three things that actually the prime broker risk manager doesn't currently know and is currently legally and civilly liable for, despite the fact it's impossible for him to know the answer, or her. And that's this: we know the moment, locus, and quantum of risk at all times in the system, and tokenization lends itself to that, which means that you're not only looking at a broader market participation and therefore a greater swell required to move markets where small numbers participating in market do lead to flash crashes. You've got a broader number of people in there, and you actually have a real sense of where the risk is, because actually within a tokenized market, things are not going from one prime broker's desk to another, nor are they sitting within the same prime broker's deal desk. Instead, they're actually moving through the market and are visible in the market, so we can really see what's happening. And so I think that the point to this is there are all sorts of ways that we can fractionalize assets in a way that provides access to people as we go through the various regulatory hoops over time toward a broader and broader participation. But actually, the interesting piece, I think, around this from a financial markets perspective is that we're actually creating the capacity for risk management and security of markets in a way that hasn't been the case or hasn't been possible before, especially in the post-2008 era, when most of the risk moved out of banks into hedge funds, which are now dealing as prime brokers.
We look at the Charlie. If we look at the new,
Yes, Richard. Yes.
I was going to say, if we look at the new digital assets that we're talking about here, is we've been well served. You love them or loathe them. Equities and debt as a capital market that exists today is fairly efficient. I wouldn't say it's perfect, but it's fairly efficient. We've invested a huge amount of time and effort making it so. Actually, it's a very small part of the overall asset base in the world. And you hear about private equity and private assets and private placements. All of those are not listed on the equity markets, not listed on the debt markets. And it is that start of that that we start moving through until we move into ships, containers, artwork, and lots of other assets that are there that may be hanging on a wall in a museum. And that's where tokenization starts to connect in with securitization. Now, securitization gained a bad word as a bad rep back in 06, 07, certainly in 08, when we heard about asset-backed securities and the subprime market. That black magic that was being done by those investment banks is now a commodity service. And there's a quantum reduction in the cost of running that. So where it used to be £500,000 or dollars to list an equity or to create a bond, a security, now it's only 50,000. So suddenly, actually, what's happening, just as Greg was pointing out in the retail space, the Googles and the Apples are coming into the retail banking space and taking bits of the financial services out and putting it into their WeChats and their Telegrams and their Facebooks. Actually, what we're seeing in the capital markets is the other verticals are starting to come in and say, actually, I can do that in-house. I can securitize my balance sheet. I can take houses off the balance sheet as I build them, or cars as they come off the factory floor. And you can go through into the high net worth individuals who are standing there looking at their artwork and saying, actually, I can hand this off, or museums can hand this off. And others then can take that, and instead of it being a unit size of millions or hundreds of thousands, the unit size now is dollars or tens of dollars, because we've got the technology to actually project those assets into the wider investor base. And that securitization, the turning of an asset into a security, and then the tokenization, taking of that security, and then being able to efficiently operate it across a larger investor base, are the things that are coming together to actually take what we would call private assets, not the public ones you see on the stock markets or the debt markets, the private assets that you see hanging in a museum or rolling off the factory things. Those are what we're talking about when we talk about tokenization.
Okay, guys, we're thank you very much, Richard. We're running out of time. I'm going to go to an audience question now, which we've got come in just now, and it runs this: geographically, what areas are we seeing adopting digital assets? Where in Europe and where in APAC? And that's for anyone in the panel.
Steve, you want to take that?
So, yeah, sure. So Steve here again. So I think, look, again, for legacy reasons, I think the two digital asset capitals in Europe are very clearly London and Zurich. And that is not because of 11 years of Satoshi's white paper. It's because of 300 years of capital flows between emerging markets and developed markets through these two portals. And so that is very clear for me that those will remain to be very much the capitals in terms of the digital asset flows. As I said earlier, I believe fundamentally that digital assets mean more to more people in emerging markets than they do to those as still something of a pro-cyclical luxury good in developed markets. I think that some of the big impulses that we're getting to the system, at the end of the day, all financial services, we need end clients. We need industrialists, we need the consumers. And I think more of those big corporate players are going to be coming from emerging markets, particularly, as I say, the natural resource, where there are very clear benefits, A, for funding, B, for broadening the market, getting new types of participants into wanting to own their underlying product and offtake. And I think that's very much going to happen, right across Central Eastern Europe. I think it's going to happen across Asia. I think we're going to start to see that come out of Sub-Saharan Africa as well. So I think basically my starting point is, okay, let's look in the world who actually has got the biggest delta benefit to their current, let's say, equity capital market circumstances. So I look at those industries, I look at those countries, and I think most of that flow is going to continue to come through London and Zurich.
London. Thank you, Steve. Listen, we're running out of time. We've had a great chat. I might ask, it's just gone so quickly. I might ask each panelist to give us one closing comment. If there was one thing, a short closing comment, because we haven't got a lot of time, if there was one thing you would like the audience to take from today's discussion, what would that be? Let's start with Richard.
Thank you, Charlie. So from my perspective, obviously we're from Lab 577. We sit in the nexus of emerging tech and financial services. We're very much in this space. Over the next 10 years, we see all financial assets moving onto distributed ledger. I'm not sure what the winner will be in that space, but for us, we built digital asset shared ledger, Dazzle, to allow financial institutions to issue, manage, exchange, settle those digital assets over one of the networks. For those of you in the room or on the call, you can reach out to us at dazzle.io, DASL.io. If you want to talk to me after this or catch up for questions, more than happy to take them.
Thanks, Richard. Greg, briefly, one thing you want the audience to take away and think about.
The comment Richard made before his closing comment in regards to digital assets and the potential therein, whether it's classic cars, paintings, whatever, that I think he summarized the whole point, that we can go beyond the classic asset classes and move into more alternative asset classes and bring those into tokenized space is actually a big thing to take away from this. But what I would like to get people to do more of is ask good questions. Don't think that someone talks about blockchain is able to do magic. They're not. There is no magic in blockchain. In fact, it is merely the first iteration of distributed ledger technology. I would really like to see more people asking questions that go to how applicable is this? How do you scale? How do you achieve this? When you're talking to people who are from the sort of the classic blockchain camp and they're advocating this, you look at it and say, well, please explain to me how 17 transactions per second is going to sustain capital markets, much less retail banking. I really, because one of the difficulties I have is we as a group of people, Richard is one of those people I've known for a little while, and Richard is a very erudite thinker in this area. What we are not getting enough of is people like Richard or people who have a point of view that is based upon reality from capital markets, from financial markets, speaking to the audience, because actually what the market has rewarded to date are essentially claims that we can put leprechauns on the back of unicorns and transport them from wishing well to money tree.
Wonderful.
And the market has responded very well to that lie, but there are others of us who are coming to market saying much more practical, grounded things that are based upon the understanding of what sort of scale is required, what sort of security is required. And it would be nice if people asked us more often those kind of questions.
Thanks, Greg.
Hi, Charlie. It's Mike here in the room in Dublin. I'm going to ask that question. I've got a question, if you mind, if I can jump in. We're not finished asking questions here in Dublin. I think your point's really well made. I'd like to ask a question, and I'm sure everyone in this room would. You know, we've got central bank intervention, we've got negative interest rates, negative yield. Financial markets are clearly broken. We talked about the boom and bust cycle. So when you talk a dawn of digital capital markets, or a dawn that we're going to revolutionize this for us as citizens in the worlds that we live in, is this in danger of just becoming a new way that banks and financial institutions do the same old thing? So what would you do from a legislative perspective or a regulative perspective to say, actually, this could be the answer. This could be the resolution to stop this boom and bust cycle, particularly in light of, just look at the equity markets and among the volatilities involved. Just look at gold. Just look at negative yield curves. Just look at corporate debt at the moment. I mean, it's fueled out of control. I'd just like you to touch on that. You know, if it's going to be a new dawn for capital markets, is this the answer?
So if you look at, this is an age-old question. It's not 10 years, 100 years. It's been going on for a lot more than 100 years. There's a reason why you have the sovereign's head on the coins in the UK and in most countries, is because back in the medieval times, the merchants wanted to create their own currencies, and the kings and queens wanted to own, or the sovereign wanted to own that currency because you could tax it. And that tussle you're watching going on right now. The money that Facebook put into Libra project and set up, that is a merchant attempting to create a private currency that they could then use within their own operating system or their own system. That is a merchant, no different to the big fat merchants you saw on the dockside in the medieval times. And there's a reason why the king's head is on that coin. It's why you saw the central banks respond so aggressively. You don't see central banks move so quickly as they did to close down Facebook. And it doesn't help that Facebook is kind of public enemy #1 in the US. Probably not the right time to be rolling out Libra. But from that perspective, what you watched last year was that classic age-old tale of, is this sovereign-owned or merchant-owned? What has started is a recognition of that debate one more time as to who should own this. Is it the elected politicians and thus the sovereign, or should it be the merchant that are actually operating it? Currently in China, WeChat covers off the majority of transactions. They have wiped out Visa and MasterCard. And if you watch what happened with Bitcoin since 2015, they've been exiting their wealth that they've been gaining in China out of China and using Bitcoin to do that and get it offshore. So there's a conversation to be had as to what are you attempting to do. It's not about banks anymore. It's about what, as a set of people in a country, do you want your currency? You've elected a set of politicians to run the European Central Bank. That European Central Bank acts on your behalf to operate that currency. If you want a merchant like Facebook to run it, that's what Libra is about. Now, there's a question as to whether you think Facebook could run it better than the ECB. I'll throw it back to you, Mike.
Look, to the whole issue around central banks, you know, I think Richard's nailed the history there extremely well, and the current debate in that context. I would put another point to you, which is this: that the central banks, starting with Alan Greenspan and the cure to irrational exuberance, actually pumped so much money into the system that I remember back then looking at this cliff of new money in the system, and it looked huge. You know, when you looked at the graph from 1910 through to that point, of this consistent sort of bubble, and then all of a sudden this great big jump, and that little jump turned out to be nothing more than a pebble in the road next to what happened in 2008, when there was a complete destruction of value in currencies. And you know, there's very long and very lengthy economic arguments you can have all around this, but fundamentally we're seeing a bubble of everything. We're seeing a situation where the average person is priced out of being able to buy a home. This is why we've seen a drive towards socialism, because clearly the answer to problems getting homes is to make sure that no one can build them by having a socialist system. But you know, jokes about socialism aside, which is all too easy a thing to make jokes about, what we really need to see now is far more engagement from the central bank in these issues, because they are coming. You know, when you look at the Bank of England, I believe, are making quite a few inroads on this. The ECB are sort of playing at the sides of it, I believe, but in China they're going headlong at this. And this whole issue around how do we actually, what is money and what does it mean to people? Is it actually a currency? You know, what are the tests of a currency? A lot of people talk about Bitcoin being a currency. I'm not trying to reopen that particular grave, but I think there are 18 tests for a currency. And when I wrote those 18 tests out in 2001, your fiat currencies would generally pass it. Generally, just about. Now I'd argue that they by and large fail their own tests.
So
which isn't to excuse Bitcoin, which fails all of them. But
so Bitcoin first up. Now we have run out of time. I want Stephen, a very brief last word from you. One thing for the audience to take away today. 1 minute.
Yeah. Look, just to try and sort of fold into the last point, digital assets, I do not believe, are going to solve for world peace overnight. Clearly, the capital system that we have, the capitalist system that we have at the moment, is clearly flawed, and I expect that will not look in its present form, by the end of my generation. But right here, right now, again, replaying that equity playbook, I believe that up till now, one of those big functions the investment banks did 20 years ago, the portfolio margining, the securities lending, that simply has not existed to date in the digital asset realm. Many of the brokers and the OTC desks, they call themselves prime brokers. They do perform some of the ancillary services that a prime broker does, but at the heart of it, they simply have not yet been able to put together the three key elements required for portfolio margining for a true prime broker that is truly at the heart of any effectively operating capital markets. And that's that. So if people want to hear more about that, because that is coming very soon, feel free to reach out to me on LinkedIn. Thank you.
Great. Listen, we've run out of time, I'm afraid.
The three things systemically changed markets are extremely simple.
Oh, sorry.
The moment
Start speaking now.
quantum of risk. Those are the three things we need to know to fix financial markets.
Okay. Thank you very much, everybody. It's been a fantastic talk. Thanks to Lab 577 for bringing this session to the market, and to the panel, Steve, Greg, and Richard. Thank you very, very much indeed for your fascinating insights. Now, everybody in the room, this session's been recorded and will be published shortly, so you can revisit it. For more information or to discuss any of the topics from today, our panel's inboxes are always open. You can connect with them on LinkedIn. The details should be on the screen now. They are, I can see. Until next time, thank you very much for attending. Thank you again to our panelists. Thank you to Lab 577, and looking forward to welcoming you to the next one. Thank you, everybody.